Hi, everyone, and thanks for joining us today for our webinar on finding low-risk opportunities with Briefing Trader's technical analysis. My name is Mike Midland, and for those of you on Trader Trials, I'm going to be your sales contact. I'll be joined by Scott Smith, our Chief Market Technician, who trades and writes under the custom ticker BLUEX. Scott is going to detail his daily process for finding the best low-risk trading setups. But before I toss it to him, I'll quickly show you how to find his trading calls and analysis in Briefing Trader. So now we are looking at the default landing page for Briefing Trader. You'll see Scott's trading calls, commentary, pre and post market analysis stream under the BLUEX ticker here. You can also do a search for BLUEX content by typing BLUEX in the search field. So let's go ahead and do that now. Okay, so you can see we can pull up all the history of all his trades and analysis from today. If we scroll down a little bit here, there's a trade on Apple. Here's some notes within the first hour. We go down a little bit more, actually. He caught a real nice trade here in Amazon. You can see up 28 points from the swing from last week. So now let's go over how to set alerts within a portfolio to let you know live when Scott's actually placing a trade. So I'm going to close this out. And before we do this, we're going to check out these custom tickers real quick. So you click on this orange tab here. And you can see here, this lists all our trading call tickers as well as our topic-based tickers. So you can see this is Scott's custom ticker up here, BLUEX, as well as the other traders you've seen during the trial. If I scroll down a little bit down here, you can also see the other excuse me, ticker that Scott writes under, which is swing. This is a swing trader updates. So let's close this out, and we'll go ahead and set up a portfolio. So if I go up here to manage, or excuse me, portfolios and emails, you just click manage portfolios and emails. Really easy. I'll click get started, and we'll just name this test, T-E-S-T. Click save and continue. Now we can enter the separate tickers that we want to see alerts and live emails on. So let's enter Scott's ticker BLUEX, swing, which is the other column he writes on, as well as a few stocks, like Apple, Citigroup, and Amazon. Okay, so now I just click add. It sends everything to the right here. We click save and continue. And you can see here, we've got our own portfolio set up. Now within this, you can drill down. The frequency default is set for live, since the majority of people will just want live updates, any trades or any news topics on their stocks. And you can also filter your topics down here. As I move down here now, this is where we set the alerts. So you can either set a visual alert or an audio alert. And in that essence, when you set a visual alert, you'll get a window that will pop open and stay open for a couple seconds when there's any trade by Scott under BLUEX or any stock in your portfolio. You can also set audio alerts, which works just like Siri, where you get a 2 to 3 second audio, which will let you know when a trade is placed. Okay, so now I'm going to click finish. Close this out. Okay, and then you can see up here under the portfolios and emails, we now have our test portfolio set. Okay, so now I'm going to go back to dual and play. And I wanted to show you a little bit more of Scott's work on the site. So if you go over under investing and trading, you slide down under TA page scans. These are some different strategies that Scott runs daily screens for. So with that, I'm gonna toss it over to him, and he's gonna take you through the rest of his work on the trader service.
All right. Thanks, Mike, for that introduction. Appreciate it. All right, I'd like to first off thank everyone for taking time out of your busy schedule to listen to this webinar today. Hopefully you walk away with some tidbits of useful information and tips that you can use in your trading on your way out. And ideally, you like what you see and you kind of subscribe and you follow along. We would start making money together going forward. So the first thing that I'd would like to cover, I do have a slideshow here. Let's just go back into that. Is that trading is actually very easy. Now, with the advances in technology over the last 2 decades in the internet, it has been easier than ever to buy and sell securities. Anybody can do it from anywhere in the world. In fact, it's become so simple that we've heard so much about this high frequency trading, which is literally executing orders in thousands of a second, in milliseconds, which is fantastic for brokers because they're making all their money off their commissions and whatnot. It's funny. That just quickly reminds me of a story about I saw a guy speak about high frequency trading about 2 years ago, and he said that in order to execute orders any faster than they already are, they'd have to be executing them faster before you hit the buy and sell button. I mean, they're completely maxing out the capacity that they can execute orders on a speed basis. So that with that in mind, the trading part of this and getting the mechanics down is extremely simple. It's the actual making money part that is actually very difficult, and that's where you have to really have some sort of edge, a low risk edge, in order to pull profits, pull money out of the market. So recently I had a little vacation and I wound up going to Vegas for the first time. And it was interesting, for my first time there. I've been in casinos before. Nothing's changed. It's all the same games, and the house still has their built-in edge to everything. And I started thinking while I was at these casinos and watching some shows, what exactly is the difference between gambling versus trading? 'Cause I haven't been in a casino in probably 10, maybe even 15 years. And what I came to the conclusion was that, when you gamble, the odds are stacked against you before you even start. And you're really just kind of sitting there doing some sort of basic strategy, and you're really relying on luck to propel you to become a winner. But essentially, the house always has the edge, and you're just going to be a loser in the long run. So compare that to trading or speculating, whether it's a swing trading or scalping or day trading or even just a long-term investor. Um, what you're really doing that's different from gambling is that you're putting the odds in your favor, or essentially more, you're waiting for the odds to be in your favor. And then once you see that opportunity arise, that's when you go in. Not all in. I mean, that's all in would be not managing your risk appropriately. Um, but once you go in, it's more about just managing your risk after the fact, to have that position become a winner in your favor, even more so. And that's really the main focus of trading, and that's really where determines the successful trader from the unsuccessful trader. Is if you're in the markets every day and you're just kind of throwing out random orders to buy and sell, you're going to get chewed up eventually, and you're just kind of not putting the odds against. You're putting the odds against you. But if you wait patiently and wait for that edge, um, just going to make better risk decisions. Your stress level is going to be a heck of a lot lower, and you're going to notice that your account and your profits are going to grow exponentially over the long haul. I am a technical analyst, so it doesn't mean I completely ignore fundamental analysis. I think it does serve its role in the market. However, I do, using the casino analogy, fundamental analysis is very similar to the basic strategy in blackjack. Everybody knows it. When to stand on a 16 or hit on a soft, ace, five or whatever. There's all these different types of basic strategies that everybody knows, whether a company is making money or companies accelerating their earnings quarter to quarter, whether they raise dividends or whether they do buybacks. It's the fundamental analysis that we all learn when we get into this business. However, over the long haul, that might not be all you need to make money in the market. And from a trading perspective, we definitely rely more on the price action of the supply and demand of the actual stock on the charts, the support and the resistance levels. And I compare that, make the comparison more to card counting in blackjack, where card counting, you're keeping track of the actual, let's say, flow of the higher cards, and you're waiting and to make that bigger bet to increase the odds in your favor, to get that edge over the house, and to be more successful in the long run. Now, it doesn't mean you can't lose. It's not a holy grail, type of analysis that's going to make you money 100%. But it's definitely just shifting the odds in your favor. Um, that's the one thing I hear about too over the years too. People say technical analysis doesn't work, and one of my responses is, are you using it correctly? There's so many people that can sit there and just program, say, a RSI indicator or stochastics or a moving average system, and they're just going to apply it across the board of, say, S&P 500 stocks, and then run the analysis on it and determine that these indicators don't work. But what they're missing is the bigger picture. They're missing the relative strength component. They're missing the sector breakdown of which sectors are outperforming and underperforming. They're missing, are the stocks in the downtrend or in an uptrend? You can't just rely on one single tool in order to get the job done. You have to kind of put pick every little tool together and develop a framework from which you can approach the market and again put those odds in your favor. And that's really what we're trying to do here with our technical analysis at briefing.com is we have a number of people with these experience with charting and analyzing the market through using the technicals, and we present that in different columns and different pages and different commentary on the site, and it's a lot to absorb. I'm going to admit that. Usually the newcomers to our site, they're very overwhelmed by all the information that's being thrown at them. But if you just give it enough time and you kind of pick and choose, and if you understand what you're looking for, whether you are a day trader or a scalper or a swing trader or just a longer term investor, you can actually pick and choose the ones that you like best and incorporate them into your own analysis. And if you do that, you're going to see that we're really kind of like your wingman going forward. We're kind of assisting you in your own research and your own analysis. Yeah, you could piggyback on some of our trading calls on our trading service. I mean, that's doable too. And we're going to explain and hopefully walk through our analysis. I don't recommend blindly following our trading calls just because one of us says we're buying or selling a particular stock at a level. If you don't see that level on the chart or you don't understand the logic behind what we're doing that day, or if it wasn't fleshed out well enough for you to understand it on the site, then by all means, I highly suggest passing on it. This is a long journey, a long process that takes time to kind of get a relationship together and kind of really see where we're coming from and see, you know why we're taking these trades on the site and to know why we're talking about what we are, and we're trying to walk together and push you in the right direction to get on that same page, to get that edge. So without further ado, I'm just going to kind of go into some of the features here that we have on the site. First of all, we did release a briefing.com smartphone app that you can download on your iPhone and Android. It's excellent. We came out with it, I believe, last summer, and it's basically everyone has their smartphones on them these days, and it's one of these things where I'm pulling up the app and you're getting full live in-play coverage, just immediately at your fingertips, no matter where you are, whether you're commuting to work or on a weekend or at a kid's soccer game, and you also have access to all the columns. So as they get published, you can actually do a search in the drop-down menu on the app, and you can just read a swing trader. You can read a technical take or look at one of our focus lists and just kind of review them right off the bat, no matter where you are. So if you haven't done so already, I highly recommend downloading that app onto your smartphone. So to cover some of the pages, I do write the Swing Trader. It's once a week, my thoughts on the market. And again, my thoughts are very technically oriented. So I'm basically going to be following the trend of the major indices. It's a top-down approach usually, following the major trend of the indices. However, when things get pushed to an extreme, and you start getting these oversold and overbought readings among certain breadth indicators, advanced decline lines, put call ratios, et cetera, I tend to take the contrarian approach and to play more fades and more bounces. But for the most part, I am going along with the current momentum at hand. I could show you an example of some of these pages as well if I just escape out of this second. So the Swing Trader page that Mike showed you is under Perspective and Swing Trader. And I recently wrote about my trip to Vegas and what I learned, but I already just described that to most of you guys. And it just kind of gives you a quick highlight of, some key charts that I think are worthy of noting to help in your overall, analysis and laying that framework for you to approach the new work week. And here I just show the relationship between gold and the US dollar and crude recently and bonds. And then I'm always going to highlight some sort of major index, usually the S&P 500, and some sort of key level. So last week I was talking about how RSI, a 5-day RSI, was getting back into oversold territory. It was kind of creating a double bottom off the January low at the February low. And the indicators like advanced decline line, up-down ratios, McClellan oscillator, they're kind of all sinking back into their oversold territory. Now the risk comes with the overall trend being lower so far for 2016. However, you can tell from sentiment that I think I wrote up here too. The only thing bullish for me was that everywhere I looked and read over the last week or two has just been extremely bearish and saying how we're just going below 1800 in the S&P and how we're eventually going to break down. And that's possible. That's true. I mean, I don't know where the market's going to go. I'm never going to lie to anybody and tell them, we're going up 20% or down 20%. But what I'm going to do is make sure that if it does go up 20%, I'm riding most of that trend higher. I'm riding 10 to 15% of it higher. And if we go down 20%, hopefully, if I'm not writing the full thing down, I'm hedged. I have some sort of short position on in an ETF against my portfolio, or buying puts against it, or selling calls somehow to mitigate the overall risk. And that's really what it comes down to, is mitigating the risk when you approach the market. And that's really what technical analysis is doing for everybody. If you're approaching technical analysis by a strict money making approach, and you're looking at chart patterns and saying, oh, there's a double bottom and there's a pennant formation or a cup and handle, and this is X amount of money and the targets that I'm going to make if I get long the stock, you're doing it all wrong. That's not the right way to do it. The first thing you should be asking yourself is, here's the pattern. Where am I wrong? How much money am I going to lose on this trade if this thing completely fails and turns against me? If you take that approach to managing your risk first in every trade, I would almost guarantee you're going to see an improvement over the long haul. And that's really what it's all about. It's all about being consistent. It's not about getting the lottery ticket. It's not about going in big and dumping your entire account into a position, one position, and hoping you make that month's rent or anything else like that. It's literally about consistency. Trading small if you have to, but just being consistent in your approach, consistent in managing your risk. If you can do that, then the profits are just going to kind of come with minimum effort thereafter. And I know this might sound cliche if you've done some research and everything like that, but it takes a long time. It took me years to actually recognize that. And I'm not saying that I'm the most disciplined person in the world either. I mean, I play contrarian a lot, especially when the market goes through extremes and downtrends and uptrends. However, when I do that and when I do play contrarian, I even cut back my risk even more. I never trade 100% full size. I'm always trading about half size or maybe a third or fourth size, and then I'm scaling into a position as opposed to going all in and then trying to, make up for the losses thereafter. I go in slowly. And by doing that, you get a better average price sometimes, and it just helps you sleep better at night and kind of mitigate your overall risk. So when the market does turn and it does play out according to your plan, you could just start scaling out profits again, and it just kind of gives you that little leeway and wiggle room. And that, just speaking of wiggle room, that's another thing that I've noticed over the years. My trading has improved dramatically when I stopped using technical analysis as an exact science. Especially, when the market years ago, over a decade ago, it was trading in eighths, and then it went to sixteenths, and then it went to pennies. So literally, to be taking technical analysis to the exact penny, in my experience, is just foolish. You will get ripped up by those high frequency trading algorithms. You will get ripped up by market makers and to running stop orders, etc. You cannot trade the markets to the exact penny. At least that's my experience. Um, I take a much more, I hate to say laid back approach to technical analysis, but I take a much more general approach to technical analysis. I take it for trading around zones and levels and areas. I don't use it to the exact T. It's just you're just gonna always be wrong that way, and that's gonna eventually it's just gonna turn you away from technical analysis. Um, so that's that. So that's the swing trader page. I don't want to spend too much time on each one of these pages. But then another page, one of my colleagues, right, is the technical take, which is right underneath um, my swing trader column. And this is an excellent page to look at each day because he covers the major indices, mostly the S&P 500, NASDAQ markets on a daily and weekly basis, and the key support and resistance levels that you should be aware of. It's really just an excellent tool. And then he'll usually break it down on a 60-minute time frame for those shorter term traders to watch intraday. And there's even a table down at the bottom that he updates daily, just highlighting these key zones and these key areas that we should all be aware of if you're tracking these particular indices. Also here, he does give a bigger picture view of like the overall bias for the month and the week and the daily, and kind of goes into each different sector and says which one's been leading and outperforming over the last couple of things. So it kind of gets you this overall top-down, bigger picture analysis time frame. You can look into that for more details as well. So these are, mind you, these pages that I'm showing you, this is also kind of like my nightly routine or my morning routine that I get into. I'm always checking out these pages. Another one that I do daily is the technical scans. And I created this page probably 10 years ago when I started. Actually, I started over 10 years of briefing, probably 12 or 13 years ago briefing. And I was looking for a way that I could find particular patterns in the market just by running a computer scan. And I didn't want the parameters to be so tight that it would eliminate a lot of my choices. So they're kind of like these general technical patterns. And if you just look down the column here, it says pullback longs, power ups are just stocks that are up 3 days or more higher, running higher for 3 days, 3 or more days, running lower for 3 more days is power down. An inside day is where a range is inside the prior day. An inside week, which I like a lot. These are kind of like these 5-day consolidation periods where stocks tend to break out from and trend. A doji, if you're familiar with candlestick patterns, that's when the opening and the close is very close to each other. So that's on a daily basis. On a weekly basis, that's pretty significant. That too basically states that the opening on Monday was pretty close to the closing action on Friday, which translates into a consolidation or a range for the week. And again, usually you find bigger trending momentum names coming out of those types of patterns on a weekly basis. Overbought, oversold, these are kind of dangerous terms to use, but essentially the scan is looking for stocks that have accelerated outside of their 5-day range as of late, or I should say the prior week's range. And you got to be real careful with fading these type of stocks, whether you're buying or shorting them, because they do tend to be, because of their 5-day momentum is so strong, they do tend to it's more likely they're going to slip into a consolidation or some sort of mild pullback that eventually will make them show up on the shallow pullbacks and the shallow shorts candidates. So right now you could see that we have overbought and we have a lot of gold ETFs setting up right here. And if you look at the chart of gold, any one of these over the last few days, you can see that they've ran up real strong, and they showed up for today, and they're pulling back, which is exactly what the scan is supposed to do. However, this uptrend is still well intact, and so if you're day trading, I mean, this is an excellent spot to look for. Some sort of confirmation of taking out these 2-day lows would have been a good spot to go short. But you got to be well aware of the fact that the uptrend is still in play. You have support level right here, right around this gap, You have this uptrend in play. There's going to be buyers on these dips. Last week, I believe we had a couple of utility stocks. Over a week ago, I'm sorry. Over a week ago, we had a couple of utility stocks show up on the overbought list. And if you've been following the market at all, utilities have been showing really, really strong relative strength the last few weeks. I guess as a defensive play, to the rest of the market as they pay dividends, et cetera. Um, so, when they showed up here, even if you shorted this day here, you better be kind of quick because usually what happens in these names is that they tend to just kind of consolidate and show up as these pullback long candidates. Um, and you might catch other ones, on the downside. I know EA Sports, Electronic Arts, they basically got hit hard after their earnings announcement to late January, and they started showing up on the oversold scan um, about 2 weeks ago, right around here, right when it broke below $59, $60. And I started taking a really strong interest in it as a possible bounce play in the market. And as it started showing up oversold and on the power down scans, you see RSI basically came down here and broke below the 30 level, and eventually it managed to turn back up for a decent gain here. Now the market was going crazy; everything was being sold off 2 weeks ago. So I took a very conservative approach, and I believe I scaled into thirds at about $1 a piece, starting at 59, 50, mid 57s and 56s, and it just seemed way overdone with the stock down. How high was that? I think it was about 25. Yeah, about 20%. Off the high, 5 days after earnings, it was just getting absolutely hammered. And it wasn't the greatest trade in the world, but we did scale out a little profits as it came back up to 60 last week. But that's kind of what the technical scans. These are the type of trades that's going to direct you towards. Amazon. This showed up as one of the doji scans last week, and it was also oversold. You can see RSI 14 was oversold below the 30 level. It's also Amazon.com. I mean, it's one of the biggest market cap stocks out there, biggest momentum names. And for me, going off this high here, it was down approximately 30% off the high. It had earnings a week prior, and it sold off significantly for about a 24% loss. And it came down into these oversold levels, and it just seemed like one of these stocks that, it was here at this level here, and then it broke below the low and reversed back into positive territory. And I believe it was one of the first stocks on that day that actually went from negative to positive, which is a sign of relative strength. And we wound up purchasing the March 480 calls for about $24 was where I got in, somewhere around there, $24, $23. And by the end of the day, it was up 10 points, I believe. I think it was like 494 is where we got in, and it reached a high of 509. And you purchase 2 or 3 contracts of a $24 option, that only runs you about $750, less than $1,000. And here we are, 25 points higher with the stock for a fantastic swing trade, and we've made almost 90 to 100% on our options as a trade around $50. So again, but I got this idea from the TA page scans because it showed up on the oversold area, because it showed up in the power downs, because it showed up in the doji scans. And that's basically my point, is that these scans, you want to kind of go through them. And I don't spend more than 20 minutes going through these each night. I literally would just look at these scans as fast as I can. Like I could see ALR, DEC, and DTE, and I look at the scans as fast as I can. This looks like it's a takeover candidate or being bought out because it's right there. But again, the computer just spits it out. But I look at Deckers. So Deckers was a pullback long candidate for today, and it's just a simple mechanical scan where you can just see the resistance level is right here around $50, and the pullback prior to today began was just kind of right in here. You see that it's down for down about 2 or 3 days off its high, and you had a resistance level right there. You just want to keep track of this and say, all right, I'm a buyer if it clears $50, $51 area. It's been in a big downtrend. The market's trying to recover here this week. So maybe there's a possibility that I can squeeze a few dollars out of this. And, you'd be triggered into the trade today. Just these are the kind of setups that you're looking for. I believe I said ETE. What's the or DTE was the other one. So DTE is actually a utility stock, and here is a stock that had a really strong uptrend into throughout January and began pulling back a few days. And if you think utility stocks are going to go higher based upon their relative strength, and the market rolls over again and they take on a more defensive role, this is one of these stocks that is really strong, and you can just kind of draw your support and resistance lines, real basic, and identify your risk. Your risk is if the stock drops below the support level in the 81, 82, 83 area. So you can purchase this stock here, and hopefully the momentum kicks in again, and you can start selling it out for $3 higher, or trail some sort of stop going forward. I don't have a 50-day moving average on it right now, but I'm pretty sure that it's probably right in that vicinity. Let's see, that's 10. Maybe not. So the 50-day moving average is right there. So again, maybe it does have a little bit more room to come back in, since if you believe in the 50-day moving average would be a better support level. You could change it to the 20-day moving average. You kind of have to got it. Again, technical analysis is more of not curve fitting, but you just kind of want all your ducks lined up in a row to find that low risk edge. So that's basically this page. Down at the bottom, if you're interested in trading lower price stocks, that's not really my expertise, but there was a demand for that. So I did come up with a really strong, I came up with a scan that identifies the strongest stocks in the market that are under $20, and they're basically uptrending with strong relative strength, and they're above usually key moving averages. And you can see there's been a handful of gold stocks that have been on here for like the last week or two. So again, you can if that's your style of trading, this scan is usually a really good job. I call them zippers because they just kind of zip right up there with the market. If you're day trading, one of my favorite, just go-to candidates for day trading, that if you really like short on time, but you just want to track, like say 20 to 30 stocks all the time, this is the bang for your buck, which I update weekly. And basically these have high liquidity and they have high volatility, and based upon like the last few weeks of activity. And these are really going to be your go-to names if you're day trading or scalping or even swing trading if you pick out the right levels. And hopefully most of those names are familiar. The last one I want to go over real quick is my proprietary signals that I came up on the SPY a couple of years back. The formula is not too complicated. There's just a little intricacies that are in it, but essentially it tracks the momentum of the SPY on a weekly and daily basis, and it's done a pretty decent job at identifying where the current momentum on a weekly and daily basis is favorable for being bullish, bearish, or neutral. And it's just a simple traffic light color system. Red means your market's in a downtrend and bearish, and yellow means it's more neutral and flat, and then green means it's more uptrend. And at the very least, this is not a mechanical buy and sell signal. Let me get that straight first. You can't just buy and sell based upon these signals. But what it does do is that it gives you, again, that framework to create your own analysis. So it's probably going to be switching to yellow as of right now, considering that the SPY is above last week's high as I speak. So I wouldn't be surprised if this actually switched to a more of a neutral flat trading range signal, probably at the end of today's close or sometime this week if we continue higher. It's definitely not going to go on to green anytime soon. Probably not until we probably need at least another week of uptrending activity in order to see that. But overall, what it does is it helps you to at least focus on which one of these setups have a higher probability of working. And again, that's what this all comes down to again, is if you're in a green mode, you're going to want to focus more on the pullback longs or stocks breaking out of those inside ranges or inside weeks, or the wide range breakouts, which are just breaking out of these consolidations. One of these examples is Wynn Resorts, which has been a really strong leader here the last 2 days. The stock has been beaten down for over a year, this casino name, and you can kind of tell that last week it broke out, last Friday it broke out. I believe it was earnings that did it, but it looks pretty good here. And the short interest is about 20%. And this might be a name that you're going to start wanting to look at. And sure enough, if it starts to consolidate here over the next day or two, it's going to show up on the shallow pullback long scans. So it's kind of all intertwined, these scans here. Focusing on the key momentum names in the market that are always moving around. And you're going to see names jump from here to here. It kind of just gives you a whole nice little concept and framework to do your analysis on. That's pretty much enough of that page. There's plenty of webinars where I go into way more details and explain each one of these patterns. You can always email me and ask for more questions if you're interested. Another one that I want to focus on is TA page setups. This is one of my colleagues posts this. He will post his ideas basically a few times each week, say 2 or 3 times each week. And his main style is focusing on these longer term support and resistance levels in stocks that are consolidating at them or coming into them. So you can see right now he had Apple basically going off the August low and in a tight consolidation phase, and it's on his radar to either watch for a breakout or a breakdown. If we were to go to, say, one of his prior posts from last week, again, he goes after these big, long, downtrending names that are coming into these key levels, whether they're psychological, like a $5 level, or a longer-term downtrend that seems to possibly putting in a bottom of sorts. And he'll be looking for these downtrend lines to, turn higher in reaction to earnings or some sort like that. Here's Triple D, another beaten down stock over the last year or so that apparently looks like it's bottoming and can break higher. He's got a pretty good track record and good feel for these bottom fishing type of names, if you're interested in that. Liquid momentum under the technical analysis as well. I do focus on this page a lot. So this is a page where we focus on the top 50 leaders of the market based upon relative strength and relative performance over the last, it's ranked upon a last month and 3 months ranking system. And a couple of the key criteria is they have to be very liquid, averaging over 1 million shares a day in volume. They have to be a good range. Their daily range has to be well above $1. So these are basically these, we call them liquid momentum. They're essentially these thicker stocks that have momentum behind them in a way. And it's funny because we created this probably about in 2009 or 2010. And what we discovered was that because of their relative strength and their outperformance, which you can usually see on these relative strength lines that I highlight on the top of each one of these charts, these relative strength lines are always in some sort of uptrend. And that's because of that inherent bullishness, that bullish factor that they're outperforming the broader market. They tend to behave extremely well to support levels, to moving averages, to trend lines, to gaps. They tend to break out over resistance levels. And that's where bigger picture technical analysis comes into play. Obviously, there's not going to be a single energy name on this list at all. Energy stocks and basic material stocks and transportation stocks have been completely destroyed the last few months. Their relative strength lines are underperforming the S&P. So in that scenario, if you're looking for shorts, those are your best candidates. They're underperforming the broader market, so you want to be shorting them into resistance levels and into moving averages. You want to be looking for that bigger momentum and trends to take play. For these names, the top 50 strongest stocks in the market for us, it's the exact opposite. When the market rallies, these things tend to lead. They tend to be going higher above their moving averages, and they also work pretty well on just textbook technical analysis. Goes back to the conversation of where I said to people that say technical analysis doesn't work, well, you have to apply it to the right sectors and the right stocks and to the right charts in order for it to work. This is a perfect example. If you've ever have read textbook technical analysis 101, and you just love moving averages and stochastics and RSI and MACDs, and you're just looking at candlestick charting patterns, you want to be focused on this list of top 50 stocks. And if you're swing trading, you can do this on a swing trading basis, but if you're day trading, you also want to be these are really good candidates to be focused on, say on a 60-minute time frame or a 30-minute time frame. One of our top stocks is McDonald's. You can see Procter & Gamble, ExxonMobil. A lot of staples have actually climbed up here on the list the last few weeks, as well as utilities, few industrials. It should mostly be names that you have heard of and you are familiar with, because they are the larger cap names in the market. And like I said, because of their inherent relative strength, they're excellent candidates to focus on the long side with. I will give one caveat. Recently in the last few weeks, a lot of these started dropping below their 50-day moving averages. And when you start noticing a whole trend like that happening, regardless of their relative strength, I don't advocate picking these up below their 50-day moving averages at all, just because that's usually the final warning sign that the leaders are actually getting hit with the rest of the market. So you really kind of don't want to be bottom feeding these if they're trading below the 50-day moving average. You probably want to be focused more on the short side from them because they've lost their leadership. In cases like this, like Chubb, you can see the relative strength was maintained, and now it's back above the 50-day moving average, which puts it back on the radar for me as a full long candidate. As long as it maintains the support, this new support, which was old resistance around 113 area, 50-day moving average, I suspect it should continue higher. Down here, I gave an example of Kellogg. There's just three things that I'm always looking for. I definitely take a keep it simple approach to the market. So you have an improving relative strength line. The stock, you can tell, has been defended or supported at its 50-day moving averages and its 20-day moving averages on 2 occasions here, which is a good sign of institutional support. And then just basic technical analysis. Here's the downtrend line on the pullback. When it broke above that and it cleared it, it's a good opportunity to get into some. And same over here last week. They reported earnings, and it kind of cleared the 72 level. You could just be jumping on board, and it's showing upside follow through, which is another key way, to just start making money on a swing trading basis. If you're interested in more of these type of trading, there's plenty of webinars that I've done in the past going into a lot more details. The focus list is updated weekly. Feel free to, I forgot to say this earlier, feel free to type in questions into the chat. I'm going to try to go through as many as I can. I really want to keep this webinar short. So I'm just going to kind of wrap things up real soon. But yes, the liquid momentum list it's not strictly for long plays. Failed breakouts like this one here in Chubb, if you can time it correctly, if you see the breakout and reverses, that's a failed signal, you can go ahead and short it. And like I said, below the 50-day moving average, these are all shorts as well. Coming off the focus list does not necessarily mean that you should just go out and short it. It just means that the stock could be consolidating or just in a mild pullback and is being outperformed by rotation that week. But if you do see an actual breakdown in price on heavy volume due to earnings or gap down or et cetera, then yeah, it's definitely a viable short candidate to be looking at. Again, I go into more details of that on some of those webinars if you're interested. ETF analysis. This is also, even though it's ETF, it's actually mostly technical because there is a lot of sector rotation going on here. And this is, again, written by one of my colleagues. He posts under ChartTrader on our trading service. And so I believe once a month or every few weeks when he feels appropriate, he puts together this big picture chart book, and he goes through all like the major asset classes that are in play or moving significantly from a bigger picture perspective. He even will look at sentiment indicators like the VIX and put call ratios, etc. And he's here to give you the bigger picture uptrend lines and the support levels that you should be focused on and transports, and kind of put the whole theme of the market into perspective on a technical basis for you. And again, the beauty of this is only every few weeks or so, and it just takes some real quick reading just to get your, to lay that framework down for yourself. If you're interested in his daily notes, ChartTrader does post daily commentary, and it's a little bit shorter, but he just highlights a few names that he's interested in and that he's focusing on some key levels and his, intraday analysis of it that he's, or what he's looking for, expecting to develop there. If I go back to the presentation slideshow to see what I have left. So on in play on the actual in play page itself, there's a number of tickers that I would recommend following because it's what I do all day long. I'm always going to follow ScanX, SummerX, RapX, TechX, LevelX, and IndexX. And anything with an X, obviously, is just scan, summary. It's a wrap up, it's a technical, it's a volatility, and it's an index. These are just tickers that we use to make the search easier in the archives. And these all come through the in-play page on our site. And what you want to do, and just to give a quick example, so here on the live in-play page, I usually have all my trading calls broken down on the right-hand side, and I have all the fundamental stuff and headlines on the left-hand side. But just scrolling through, the trading commentary, here's a SummerX. This is the kind of stuff I read all the time. I want to know which sectors are outperforming and underperforming. I want to know what names specifically have been moving the market today based upon some sort of headline that they had, whether it was earnings or buybacks, whatever it was. I want to just know what the main gist of is in the market. It's the kind of stuff that's going to show up in the paper tomorrow, and I just want to know about it ahead of time. What's going on today? Notable trends. Again, where are the actual percentage gainers and percentage losers for the day? Stuff like that. What sectors are going on? Where are the upgrades and where are the downgrades? I mean, just something as simple as SummerX. Just again, it goes into that framework. It tells you where you should be focused. Market internals, MarketX, another good area to look at just for finding relative strength, relative weakness. And here's a TechX commentary telling you banks and regional banks, semis are really strong, housing. Again, so what I'm going to do when I read these commentaries, I take 2 seconds to go to my charting package, and I'm just going to type in XLF, and I'll see that. And I'll watch KBE to see how the banks are performing. SMHs was on that list. They gapped up. Housing was on that list. I'm just kind of seeing if there's any sort of technical pattern here. You can see the downtrends. You see some double bottoms in play here. Maybe I'm going to go over to a weekly chart to see if there's any candlestick developing. See, now this is interesting. Here's this low from 2014. You go way back here, and look, there's a doji pattern from last week. And you have an oversold RSI indicator on a weekly basis. And you have this massive correction in play. This maybe housing is something that I want to start looking at. And this is as fast as my analysis goes and takes me. So what I'm going to do is I'm going to write down housing stocks, and later on tonight I'm going to go through 5 or 6 names from, I'll just go through Pulte or drawing a blank here, Lennar. There's one that begins with an R. I can't remember, but I'm just kind of I have to go through my list that I have here. I'm just going to go through these lists and just see if there's any sort of setup coming up. I'll look to see if any of the earnings are on the horizon. Maybe that's why they've been strong leading up into here. They're getting bumped up before earnings. I'm just going to kind of look to see if there's an opportunity there. And that's basically what I'm using the briefing technical commentary for. Anytime we do mention 50-day moving averages, 200-day moving averages, and again, that's just something that you always have to look at. 50-day moving averages and 200-day moving averages is just kind of this go-to average, and you just kind of want to see how stocks are behaving. For me, this isn't really much of a trading opportunity right here, right now. It's GE, it's a slow mover, it's below the 50. I'll just make a mental note of it, something to do. ScanX I like a lot. Again, it does show significant movers on volume, and it's just kind of these names that I'm going to just quickly highlight. I'll just go through CYH and PFE and just to see if there's any sort of trading activity here. PFE looks all right, nothing crazy. CYH gap down today. I assume it's earnings or some sort of headline. Maybe I'll take a closer look at it if I think it's oversold. Just kind of fancy my interest a little bit somewhere in all this stuff. And that's really kind of how I flow through our website. Again, if you try reading all this commentary, it's like impossible. It's just really difficult. You have to kind of just zone in and focus on names that you're interested in, focus in on the sectors. Any one of these names that maybe caught my attention when I did my nightly review of charts on this list here that I maybe set scans for, or that I just kind of wrote down in my notes beforehand. I said, hey, I really like this chart here, and then I'll see it come across ScanX. It's going to get a double take. I'm going to take a closer look at it and try to find some sort of trading opportunity in it. And that's really it. And you can search for all these tickers up here. You can just go SummerX, into the archive up here. And in case you don't want to scroll down through all the pages, and it will just load up here. So you can do this throughout the day. ScanX is another one. I just type that in here. See, it's just all the names here. And usually I have more than one screen, so I'm kind of just put this on one page, and I'm looking through all the charts as fast as I can. And again, I'm just kind of trying to find, if I find a good pattern that I like, or a name that I'm interested in, that's when I'm going to dive deeper into the weekly chart, into the daily chart, into the 60-minute chart. I'm going to identify my risk level on the trade, and then I'm going to focus on maybe taking a short-term entry for a swing basis and see how to approach it from there. I want to kind of wrap everything up here. I think I've covered mostly everything that I wanted to. The last thing is just risk, and again, I've kind of hopefully hammered this home. Is risk is really kind of, it's like beauty. It's in the eye of the beholder. It depends on your amount of capital that you have and your tolerance for it. My general rule of thumb is if you're aiming for consistency and planning on trading the markets on a long-term basis, year in and year out, and you have that bigger picture goal in mind to just gradually build your account, and you're aiming for consistency, if you always keep that in mind and you remind yourself of that goal every single morning and before even every trade that you place, then you're going to manage your risk the right way. If you're not aiming for consistency and you're looking for that lottery ticket and you're trying to make a lot of money real fast, and you're looking at the dollar signs and the profits that you can potentially make and the cars you're going to drive and the lifestyle that you're going to live, and your problem is going to be all gone because of all the money you have, that's just not going to happen. It's the wrong mindset completely. You just kind of have to get smaller and focus on just managing that the risk for less stress, and the profits will just kind of flow automatically if you can handle that. So that pretty much wraps up. Keep throwing this extra slide here. So I came up with this table, just along the lines of risk. This is called the Profittunity table, the opportunity to make profits. And it's just, if you have no goals whatsoever and you just have an account and you don't know what you should be making on a daily basis or at all, this is really kind of what you should be focusing on. If you're day trading, obviously you're going to want to be focusing on just making $100 a day, which will accumulate to about $24,000 a year. It's also good too if like this yearly column here, you should see where your account size fits into play. Obviously you can just keep doing the math if you have larger accounts, but if you only have, say, a $50,000 account to start off with, I would say you should not be risking more than $200 a day. And at the same time, you should probably be looking to make a minimum of $200 a day. Or if day trading is not your thing and you're looking more to swing trade, you want to be focused on opportunities that lie more around $1,000 a week. You don't want to be losing more than $1,000 a week. So that kind of is where you want to be. And again, this is a guideline. It's not nothing set in stone. There's obviously going to be partial profits, and you're going to be trailing orders and whatnot, and you're going to have worse weeks and worse months. But if you have no plan or no concept of what you're really aiming for, take a close look at this table. You can even create it yourself, but just lay out the plan, and that's going to really kind of help you figure out your position size and how much you should be risking on each trade. Like I said, the money will just kind of come automatically thereafter if you can determine and keep your risk under control. So that's the end of the webinar. It's just under an hour. A little bit longer than I wanted to do. If you have any information about your free trial, you can contact Mike. He was the guy that started the intro here, and he'll be more than happy to talk prices with you. Give you more details. You can email him, or you can contact him through a phone. If you can't get hold of him, just email sales@briefing.com. and somebody will get hold of you. And I'll just look through the Q&A here real quick. I'm not going to be able to answer all of them because it's just going to be too long of a webinar. Let's see. Do I find it better to trade news catalysts or just more focus on stocks that I've been watching for a while? That's a great question. So news catalysts, I tend to, well, I hate to say I tend to fade. It's all in context. This is what, and this is why technical analysis it won't work if you just use it in a vacuum. You have to take everything into context. So a great example would be Disney. Disney off its high from December and November was down approximately 25% going into earnings last week. And overall, that took price action back down to its August low right here. And for me, when they gapped down on earnings, it was already baked into the price. The fact that it was already down 25% and breaking down to multi-month lows, to me, told me that the big institutions that own this name have already gotten out of the stock well ahead before Star Wars even, the hype before Star Wars came out back in early December. And that the stock down here at this level, below 90 or 88 or 89, was an absolute bargain. And for me, that was a kind of a combination of technical, because I had to take it into context of where it's been and where it's at multi-month lows. Obviously, it was below. I think it was below the 200-day moving average, is right around here as well. But for me, that headline was the nail in the coffin that drew it to my attention. And then looking at the technicals and saying, hey, this gap down is kind of this one-day panic overreaction to earnings, and it's an excellent opportunity to step in and buy. So we did. We stepped up, and I believe we bought the 87.50 March calls, and we're up a decent amount in the calls. If you bought the stock around $88, $89, we're up 5% in it, $3 for a nice swing trade. And we scale out. I usually advocate a scale out process at every, whatever amount, 1-to-1 ratio to our initial risk, which is about $2 on the trade. So we start scaling out at, $2, and we scale at $4, etc. So I kind of like to combine everything. I can't really say that I'm strictly technical. A fundamental catalyst is always nice, especially when it confirms the technicals, whether it's long or short. So that kind of just fits into the way I approach the market. Let's see. Hopefully you didn't lose sound. Somebody said they lost sound. Hopefully you heard me this whole time. Otherwise, I'll have to redo this webinar. Let's see. Do I use futures? I do use futures. I trade them as well. I just feel like a lot of subscribers, that you have to pay for a different feed to get those to get access to that. So I usually just kind of focus a lot of my analysis for the site, for the purposes of the site, on just the SPY, QQQ ETFs, because I know everyone has access to that, or even just the major indices. But I do actually incorporate the E-mini futures, for the NASDAQ and the S&P into my own analysis, and I trade them occasionally. But yeah, it's all big picture stuff that we do a lot of the dirty work and grunt work behind the scenes here, and we kind of just put our best foot forward on the site for you guys to, hopefully we make money together on all that and to shorten your time, of the amount of research and time that you put into this, that you have to do. Let's see, on the technical scans page. I don't, again, I'm not going to be able to get to all these questions, so feel free to email me directly. You can at swingtrader@briefing.com. That's swingtrader@briefing.com. Or you can just go right directly to Mike Midland at his email, and he'll wind up forwarding anything to me that if you couldn't get contact with me. My charts are eSignal, but I also use stockcharts.com. I have no affiliation with either one of them, but I just long-term user. I find them to be very simple to use and draw trend lines on and set alerts. Let's see. Earnings trades, yeah, when earnings come out, I have a whole another webinar on that. You can go to our YouTube page, Briefing TV. That's Briefing TV. Just search for it on YouTube, and there's a ton of videos there. And I have a webinar entitled "My Favorite Earnings Patterns That I Like to Trade," and it goes specifically into gaps and you know the bigger the gap and the smaller gaps and how I approach them and how I like to focus on stocks after they consolidate 3 or 4 days after earnings have come out, because I find those are the lower risk opportunities that develop. So there's a whole new webinar on that you can check out on the YouTube page. I do not consider volatility or implied volatility or historical volatility on my options trades. I'm pretty much going right for the direction. When I do trade options, I look about 1 or 2 strikes in the money, and I go about a 1 or 2 months out, I should say, for the expiration date. And it's pretty directional. Occasionally, I'll sell an option if I feel like there's a better opportunity there to collect a premium. But I usually do it only at the market extremes when I'm fading. But for generally purposes, I understand time decay is rapid during the last 30 days of a stock's life. But I find that with my analysis, I don't have to wait 30 days for it to get into the money. And by trading options that are in the money, there's the time decay is a little bit less than when it's out of the money. If this is all Greek to you, I'll have to do a whole other webinar on option trading. But yeah, so for the most part, I am just trading more of a directional options, pretty close in the money and 1 month out. That's pretty much it. So anyway, hopefully pulled some information out of here. At the very least, again, it's about managing your risk, and hopefully you learned about a few areas of our website that are going to help you with your analysis and kind of create these opportunities and give you these ideas that you could really kind of just put a little bit of money to work and manage the risk accordingly going forward. And if you want more guidance, in that area, well then Briefing Trader, this is what we do for a living. We kind of find these low risk opportunities, and we walk everyone through our trades of partial profiting and taking the losses, and we kind of just go through this process day by day, week by week, year by year, to gradually build up our accounts. So if you're interested, again, contact Mike Midland, and thanks again for listening.